Building business credit. Introduction. Let's face it, building a successful business takes more than just passion and hustle. It takes strategy, especially when it comes to money. That's where business credit comes in. In this journey, we'll unpack exactly what business credit is, how it's not the same as personal credit, and why understanding the difference can be a total game changer for your business. We'll introduce you to the concept of business credit, explaining how it's different from personal credit and why it's crucial for your business. You'll learn the steps to build business credit from the ground up, including establishing a business entity, opening a business bank account, and applying for credit. Maintaining strong business credit. Once you've built your business credit, we'll show you how to maintain it. You'll learn how to check your business credit score, avoid common pitfalls, and keep your credit in good standing. Applying for business credit and loans. Finally, we'll guide you through the process of applying for business credit and loans, from understanding different loan types to preparing your application. Introduction to business credit. Let's talk about why this matters. As a business owner, building good credit is just as important for your business as it is for your personal finances. Seriously, this isn't just extra credit, it's a core part of running a successful business. Why? Because business credit gives you options. It allows you to borrow money when needed, negotiate better deals with suppliers, and ultimately grow your business over time. And if that sounds like something you'll need, you're in the right place. But before we dive in, let's start with the basics. What exactly is business credit? And how do you even begin to build it? Don't worry, we're going to walk you through it in simple terms, and we'll even throw in a few real-world examples to make it all easier to wrap your head around. What is business credit? Think of it like your business's financial reputation. Business credit is a record of a business's financial history, showing how well it manages its debts and obligations. So, just like you have a personal credit score that helps lenders decide if you should get a loan or a credit card, your business has a credit score too. Banks, suppliers, leasing companies, pretty much anyone your business deals with financially use that score to decide whether or not to work with you, and on what terms. And here's the cool part. A strong business credit score can help your business secure loans, lease equipment, get better terms from vendors, and even lower your insurance premiums. It's kind of like having VIP status when it comes to money. It gets you access and advantages that can really move the needle. On the flip side, a poor credit score can make it harder to get financing or favorable terms, which can seriously limit your business's growth. And we don't want that for you. Personal credit versus business credit. Why knowing the difference really matters. Let's be honest, if you've ever felt confused about the difference between personal credit and business credit, you're not alone. It's one of those things no one really explains until you're already knee-deep in running a business. But understanding the difference, it can save you a ton of stress and money down the line. While personal credit and business credit are similar in some ways, they're used for very different things and by different people. So let's break it down. Nice and easy. Personal credit. This is tied to your Social Security number and reflects your personal financial history, things like how you've handled credit cards, car loans, student debt, or a mortgage. Lenders use this score to decide if you're likely to pay back personal loans. Think of it as your financial reputation as a person. Business credit. This is tied to your business's employer identification number, EIN, basically your company's version of a Social Security number. It shows how your business manages its own debts. Lenders, suppliers, and vendors use this score to determine how financially healthy and trustworthy your business is. Here's a quick example. Let's say you're buying a car for yourself. You go to the bank and they'll check your personal credit score. But if you're applying for a loan to buy new equipment for your business, that's a job for your business credit score. Simple, right? But here's the thing: so many entrepreneurs end up using their personal credit for business expenses without realizing the risks. That can lead to mixed finances, high personal liability, and limited growth. So if you've been doing that, don't beat yourself up. You're learning, growing, and taking steps to do things better, and that's what really matters. Now let's keep going and talk about how to build strong business credit so your company can stand on its own 2 feet. How business credit is built. Step by step, one solid move at a time. Let's be real: building business credit isn't something that happens overnight. It takes time, consistency, and a little patience. But here's the good news: if you take the right steps early on, you'll set your business up for long-term success. And once that credit foundation is in place, everything gets easier: getting loans, securing vendor terms, even qualifying for better insurance rates. So if you're starting from scratch, don't stress. You're not behind, you're just getting started. Let's walk through it together, step by step. 1. Establish your business as a separate entity. This is where everything begins. The first step to building business credit is officially separating your business from you. When setting up your business entity, your LLC, you should first search your state's corporation division website by typing in business entity search to make sure that no one else has the name that you would like to use for your business. Also, make sure the name you choose has some sort of description of what your business is or does. On this same website, search and fill out the Articles of Organization form to establish your LLC, which is short for Limited Liability Company. Also, it will be beneficial to use a business address and not a personal address when setting up your company. If you don't have a brick-and-mortar location, you can get a virtual address. It just looks better to lenders. Another key component is to get a website. Having a website will display to lending institutions that you are a professional and serious about your business. A website does not have to cost a lot of money. You can access Fiverr.com and search website creation. You can get a simple one done for as low as $100. Why does this matter? Because lenders, banks, and credit bureaus don't just look at your passion or your plans. They look at your paperwork. And having your business legally established is the first sign that you're serious. Example: Jane decides to start a graphic design business, but instead of just freelancing under her own name, she forms an LLC called Jane's Designs LLC. Now, she can start building credit under her business's name, not her personal one. That's a smart move. 2. Get an employer identification number, EIN. Next up, you'll need an EIN. It's basically your business's version of a social security number. You'll use this number when filing taxes, applying for a business loan, or even opening a business bank account. It's free and easy to get from the IRS website, and it's one of those small steps that makes a huge difference down the road. Example: after forming her LLC, Jane heads to the IRS website and applies for her EIN. Now, instead of using her personal social security number for business transactions, she uses her new EIN, keeping her personal and business finances safely separated. Get a DUNS number. The Dun & Bradstreet DUNS number, short for Data Universal Numbering System, is a 9-digit unique identifier for businesses, which help to evaluate potential partners, seek new contracts, apply for loans, and so much more. To get a DUNS number, access their website at www.dnb.com. 3. Open a business bank account. Once you have your EIN, it's time to open a business bank account. This isn't just for keeping things tidy, it's a major factor in building business credit. Why? Because when all your business income and expenses go through a dedicated account, it creates a financial footprint that credit agencies and lenders can follow. When opening a business account, it's best to start off using a credit union. Search credit unions in your area and make sure they have products for small business owners. After establishing and building your business up, connect with a community development financial institution, CDFI, in your area. A CDFI is a financial institution, like a loan fund, credit union, or a community development bank that focuses on providing financial services and capital to underserved communities, especially those lacking access to traditional financial products. Here's a little insider tip. If you happen to have a lump sum of money, maybe from a tax refund, you can actually open 2 or more business bank accounts and fund each one with a portion of the money. Then, while you're at the bank, ask the banker what kind of small business products they offer. You might be surprised at what's available. And when you're ready to apply for credit, you can apply to multiple banks in one go. In the early days, some banks may ask for a personal guarantor if your business hasn't built enough credit yet, and that's okay. It's part of the process. Example: Jane opens a business checking account for Jane's Designs LLC. She deposits her business income into it and uses it for all her business-related expenses. This keeps everything neat and separate, and it shows lenders that Jane's business is organized and financially responsible. 4. Establish trade credit with vendors. Start small, build smart. One of the easiest and most practical ways to start building business credit is by setting up trade credit accounts with vendors. What does that mean? It's when a supplier allows you to buy goods or services now and pay for them later, usually within 30 days. These are called Net 30 accounts, and they're a fantastic starting point for new businesses. Think of it like this: the vendor is giving you a short-term loan based on trust. And when you pay on time, that positive payment history gets reported to business credit bureaus, which in turn helps you build a solid credit profile. But wait, there's more. Here are a few places to consider applying for credit to help accelerate your growth. Uline is great for shipping and office supplies. www.u-line.com. Grainger is good for tools, equipment, safety products. www.grainger.com. Maverick Office Supplies. www.maverickofficesupplies.com. Quill is good for paper goods, electronics, cleaning supplies. www.quill.com. Lowe's is good for home improvement or business property needs. www.lowes.com. CDW.com is perfect for electronics and tech needs. www.cw.com. A helpful tip? Try applying for at least 3 of these trade accounts per month. Then, make sure to pay off the full balance, no minimum payments, no delays. Within 30 days, you should start seeing those accounts show up on your business credit profile. And that's when the magic really begins. Example: Jane needs office supplies for her business, so she places an order with a vendor that offers Net 30 terms. She receives her items right away but doesn't have to pay the invoice until 30 days later. She pays it off on time, and the vendor reports her prompt payment, which gives her business credit a helpful boost. Getting better terms from suppliers. Build trust, get perks. Suppliers love doing business with companies that pay on time and keep their accounts in good standing. When they see your business has good credit, they're often willing to offer better payment terms or even exclusive discounts, which is a huge help when managing day-to-day expenses. Having those extra few days to pay or a price cut on bulk orders can make a big difference, especially when you're juggling cash flow or preparing for a busy season. Example: Jane has built a solid relationship with her office supply vendor. Because she's been so consistent with payments, They now offer her a discount on bulk orders that helps her cut costs and boosts her profit margins. 5. Apply for a business credit card, your next level tool for building credit. Once you've got a couple of vendor accounts going, it's time to step it up and apply for a business credit card. This is another powerful way to build credit, especially when you choose a card that reports to business credit bureaus, not just personal ones. Start with a card designed for new or small businesses, even if the credit limit is modest. What matters most is how you use it. Keep your balances low and pay them off in full each month. This kind of consistent, responsible usage works wonders for your business credit score. Here are a few reputable credit card companies you might consider when applying for a business credit card: Bank of America Business Advantage Card, Chase Inc. Business Card, Sam's Club Business Credit Card, American Express Business Cards. Example: Jane applies for a small business credit card. She uses it to pay for monthly software tools and design platforms she already uses. Instead of carrying a balance, she pays it off in full each month. This shows lenders she's responsible and capable, and her credit score starts to rise. How business credit is used. Turning good credit into real opportunities. Now that you've been doing the work opening accounts, paying on time, and keeping things organized, it's time to talk about the rewards. Because once you've built up solid business credit, you can actually start using it to move your business forward in some pretty powerful ways. Let's explore a few of the most valuable ones: qualifying for loans and financing. Fuel your growth without the stress. When your business has a strong credit score, you suddenly have more options on the table, especially when it comes to loans, lines of credit, and other types of funding. This can be so important when you're ready to expand, invest in new equipment, or need a little breathing room to manage your cash flow. The best part: good credit often means better interest rates and more flexible terms. And that can save you a lot of money and headaches over time. The Small Business Administration offers so much information for your business. Most importantly is the 7A loans, 504 loans, and microloans. Go to sba.gov, choose which one is right for you, and follow the prompts on how to apply. Example: after spending a year building up her business credit, Jane decides to take the next step. She applies for a small business loan to buy a high-end printer for her design work. Thanks to her strong credit profile, she gets approved easily and qualifies for a low interest rate. That means more money stays in her pocket long-term. Lowering insurance premiums. Yes, even your insurance gets cheaper. Here's something most people don't realize. Insurance companies sometimes check your business credit score too. Why? Because a business with strong credit is seen as more stable and less risky. So, if your credit is in great shape, you may actually qualify for lower insurance premiums, and that's more money you can reinvest into your business. Example: when it's time for Jane to renew her business insurance, her provider runs the numbers and sees her excellent credit score. As a result, they offer her a lower premium. That little credit score ends up saving her hundreds of dollars on her annual policy. At the end of the day, business credit isn't just a score, it's a tool. One that helps you grow smarter, operate smoother, and save money in the process. How to maintain strong business credit? Because building it is just the beginning. So, you've started building your business credit amazing. That alone puts you ahead of the game. But now comes the next chapter, keeping it strong. Why does this matter? Because good business credit isn't a one-and-done achievement. It's something you nurture over time. And the benefits? Totally worth the effort. We're talking better loan options, more trust from suppliers, and the kind of financial credibility that helps your business thrive. Don't worry though, maintaining strong credit doesn't have to be complicated. In this chapter, we'll show you some simple, realistic ways to keep your business credit in great shape, with examples you can relate to. Why maintaining business credit matters. It's all about trust and opportunity. Think of business credit like your company's professional reputation. When your credit is strong, it tells lenders, vendors, and even potential partners, this business is solid. This business delivers. A good score can open doors you didn't even know existed, like better loan terms, lower interest rates, and access to funding when you really need it. Example: Sarah owns a small diner in the heart of her community. Because she stayed on top of her finances and maintained a strong business credit score, she qualifies for a lower interest rate when applying for a renovation loan. That lower rate means smaller payments and more money to reinvest into making her diner even better. 1. Pay your bills on time. Simple, yes. Powerful, absolutely. Out of all the things you can do to keep your business credit in good standing, this one is hands down the most important: pay your bills on time. Late payments don't just cause stress, they can seriously damage your credit score. And the thing is, even one late payment can send up red flags to lenders or suppliers. So, making timely payments is like making deposits into your business's financial reputation. Example: John runs a printing business and has several suppliers he works with for paper, ink, and equipment maintenance. No matter how busy he gets, John makes it a priority to pay every invoice on time. Thanks to his consistency, his business credit score stays healthy, and when he needs to upgrade a big piece of equipment, he's able to get great financing terms without any hassle. 2. Keep your credit balances low. Your limit isn't a target, it's a tool. This one's all about balance, literally. When it comes to using business credit cards or lines of credit, less is more. The amount of credit you're using compared to how much you have available is called your credit utilization, and it plays a big role in your credit score. The difference between business credit and personal credit is that you can use all of the credit extended on a credit card and not be penalized as long as you're able to pay it off in a timely manner. For example, if you get approved for a credit card with a $10,000 credit limit with a 0% interest rate for a year, you can use the entire amount of money and pay it back over within the year as long as you are making monthly payments. Example: Maria has a business credit card with a $10,000 limit and a 0% interest rate for 12 months. She uses the full $10,000 to invest in equipment for her business. Instead of trying to pay it all off at once, she creates a repayment plan and consistently makes her monthly payments on time. By doing this, she avoids interest charges, maintains a strong credit score, and builds trust with lenders, showing that she can manage large credit amounts responsibly. 3. Monitor your business credit regularly. Trust, but verify. Just like you check your personal credit to catch errors or fraud, your business credit needs that same kind of attention. Things can show up on your report that don't belong there: wrong dates, incorrect late payments, or even accounts that don't belong to you. By checking your report regularly, you stay in control. You catch mistakes early and make sure your business credit reflects your real performance, not someone else's error. There are 3 business credit reporting agencies: Dun & Bradstreet, Experian, Equifax. Just like with personal credit, these reporting agencies generate a score for your business. The most widely used is Dun & Bradstreet. Their scoring system range from 1 to 100, with 100 being an A rating. You should get a subscription with a business monitoring agency such as NAV or Dun & Bradstreet. When you subscribe to one of these monitoring services, you'll be able to monitor your report as often as you like, And this will also become a trade line on your business credit that will report on your business credit to boost your business score. Example: Lisa runs a small but growing marketing agency. Every few months, she makes a habit of checking her business credit report. One day, she spots a late payment that shouldn't be there. She quickly reaches out to the credit bureau to dispute it and gets it removed. Because she acted fast, her credit score wasn't impacted. 4. Avoid applying for too much credit at once. One step at a time is just fine. Here's something a lot of business owners don't realize. Every time you apply for credit, lenders do a hard inquiry on your report. And too many of those in a short time, it can lower your score and make it look like you're scrambling for cash even if you're not. That's why it's important to be intentional. Choose your credit applications carefully and try not to apply for too many at once. Patience here pays off. Example: David is ready to expand his delivery service and he knows he'll need a loan to do it. Instead of applying for multiple loans and hoping for the best, he does his research, compares offers, and applies for just one, the best fit for his needs. This thoughtful approach helps him avoid unnecessary dings on his credit score. 5. Keep your business information updated. Small details that make a big difference. This one might seem simple, but it's often overlooked, keeping your business info up to date. Anytime you change your business address, phone number, legal structure, or even your company name, it's important to update that information with your lenders, suppliers, and the credit bureaus. Why? Because outdated information can cause confusion, missed mail, and errors on your credit report that you don't even see coming. It's a small habit, but it protects your business in big ways. Example: Olivia recently upgraded from running her business out of her home to renting her first official office space. Right away, she made sure to update her new address with her bank, her vendors, and the business credit bureaus. By doing this, she prevented any mix-ups and ensured her credit reports stayed accurate and clean. Conclusion: strong credit, stronger business. Here's the beautiful part: maintaining strong business credit doesn't have to be a headache. In fact, it's often about doing the little things consistently. By paying your bills on time, keeping your credit balances low, monitoring your business credit report regularly, avoiding too many credit applications at once, and keeping your business information current. You're not just protecting your score, you're building a foundation that supports growth, trust, and opportunity. Strong business credit opens doors. It helps you secure the funding you need, negotiate better terms, and keep your business moving forward confidently and sustainably. You've got the tools. You've got the knowledge. Now it's just about staying consistent. Your future self and your business will thank you.